Hi, everybody. Lance Browning, Income Solutions in Tyler. Hope you're doing well in spite of everything. Hope everything's going well for you. It is hot outside, and that can only mean that it's time for the 2022 halftime report. So every year we use a theme when we do our halftime reports. For instance, we've used the USA versus China, the Fed versus COVID, and last year it was inflation versus inflation. That's what's on your screen. We had the big I there on the left for high inflation and the little I on your right for low inflation. As we are all painfully aware, the big I won. Let's talk about where we are now and, more importantly, how we got here. Right now, inflation is running hotter than it has since 1982. This is obviously a problem. It might be helpful to look into how we actually measure inflation. So, using core producer, not consumer prices, generally is a better barometer of inflation. What you hear on the news and everything is the CPI, Consumer Price Index. Producer Price Index, PPI, is a better barometer of inflation. Okay, so that's the good news. Unfortunately, the core PPI for producers excludes food and energy from its calculations. So basically, inflation isn't all that bad if you aren't buying anything, especially food and energy. So last year, we defined inflation very simply as too many dollars chasing too few goods. That's your basic junior high economics definition of inflation. That has really proven to be true. Post the financial crisis in 2008, the Fed began printing money very rapidly. After the COVID pandemic really took hold in early 2020, the Fed printed an extraordinary amount of money. In addition, then President Trump and Congress began passing massive monetary stimulus spending programs. The M2 money supply, which is the blue line there, which is basically all money in all banks in America, grew exponentially. Too many dollars. The letters CPI stand for the Consumer Price Index. CPI is how we measure inflation. Here we show the inflation rate for consumers living in urban areas. Urban is the U in CPIU. Note that the cost of living in urban or big city areas is often higher than in rural areas. Even when you don't count food and energy, which is ludicrous, inflation is still running very, very high. We've talked about inflation being too many dollars chasing too few goods. That's correct. We have talked about the dramatic increases in the money supply. That was the previous slides. The other big problem with inflation is that since the pandemic 2 years ago, the global supply chain has been broken badly. Manufacturers cannot get parts, materials, or supplies. Basically, businesses cannot get enough product to meet the consumer demand surges post-COVID. This has been especially true for China. If you were to think about the amount of products that are made in China that we use here every day, it is staggering. Now, to exacerbate the problem more, China's had several more outbreaks of COVID. They also have a quote-unquote zero tolerance policy for COVID. This has caused them to shut down many major cities in that country. This has had the domino effect of shutting down much of their manufacturing. Pop quiz. What is the largest seaport port in the world? If you answered Shanghai, China, pin a star on your nose. Due to COVID, the port of Shanghai is for all intents and purposes shut down. If you thought we had supply chain problems before, just wait. One of my great frustrations with the Fed is that they only control the too many dollars side of inflation, except, of course, for what Congress spends. The Fed, have virtually no control over the too few goods part from the supply chain. We remain concerned that they believe they can control both. So I saw this illustration recently at a conference, and I thought it was just absolutely brilliant. So I'm going to steal it and take credit for it. This is the best explanation of our current inflation crisis that I can give you. So let's suppose that we are pre-COVID. Let's take a trip down memory lane. Going back, let's suppose we are pre-COVID and things are somewhat normal. So the supply chain produces 10 apples. The money supply contains $10. Well, 10 apples divided by $10 would make each apple cost $1. Pretty simple, right? So let's bring it up to speed to our current situation. We still have 10 apples in our supply chain. The Fed, the presidents, and Congress have determined that they needed to print and spend a bunch of money to stimulate the economy after the pandemic. So instead of $10, we now have $12. $12 to buy 10 apples would now make each apple cost $1.20. You see where we're going with this. Now, let's bring in the too few goods side of the equation, as they say, on the TV infomercials. But wait, there's more. When global governments shut down the global economy during the pandemic, they mortally wounded the supply chain. Let's pretend that the supply chain can now only produce 8 apples. We still have our 12 magically created dollars, but only 8 apples available to buy. Now, an apple, if you can get it, will cost you $1.50. This explains in layman's terms how we actually got here. Those of you that read our comments regularly know that we do not think very favorably of the Federal Reserve. All of us have now, in the past, or will in the future be touched by the horrible disease of cancer. And to be clear, human life is much, much more important than money. I'm not trying to equate the two. However, it is another effective analogy that we can use as it relates to where we are economically here in June of 2022. So inflation is like cancer. It spreads and it destroys. The Fed has tools to fight inflation, namely interest rates and balance sheet reduction. The Fed's tools in this example are very much like chemotherapy, chemo, and radiation. When you're being treated for cancer, the plan is for the chemo and radiation to wipe out the cancer before it wipes out you. That is the Fed's predicament right now. They want to kill inflation before inflation or their treatment for it kills the economy. The Fed can absolutely wipe out inflation by wiping out the consumer and consumer demand. They can absolutely do this. By virtue of its policies, Dr. Fed, if you will, could damage the consumer, which is also, by the way, 2/3 of the U.S. economy, to the point where there is no economic demand for anything. That would be bad. This would kill inflation, but killing the consumer would also kill the economy. Kobayashi here describes the economy as a pendulum swinging back and forth between inflation and deflation. So the Fed historically leaves interest rates too low for too long, and they increase the money supply. This is the perfect recipe for inflation. Once the inflation really hits, they panic and reverse course. The Fed follows up this mistake with the mistake of raising interest rates and reducing the money supply too much too quickly. This can lead to severe recessions where consumer demand is crushed and we morph into deflation. Lather, rinse, repeat. The Fed either does not understand this process or lacks the ability to prevent these extreme swings from happening. We remain very skeptical. We think it's pretty obvious that the U.S. economy will grow much more slowly in 2022. we saw GDP, which stands for Gross Domestic Product. That's the bottom line report card on the U.S. economy. We saw GDP actually shrink by 1.4% in the first quarter of this year. While we do not expect any more negative quarters for the economy, we do not expect anything like the economic growth that we had in the last year and a half post-COVID. We'll talk more about our outlook at the end of this report. So those of you that read our comments regularly know that we've talked about the big four market and economic indicators that we use. The leading economic indicator index, corporate earnings, the Fed's balance sheet, and the Treasury yield curve. Earlier this year, the Treasury yield curve did what we called an inversion. To explain, common sense would tell us that the longer you invest your money for, the higher your rate of interest will be. When things are running normally, this is the case, but this did not happen recently. For about a day and a half, the 2-year Treasury bond actually had a higher yield than the 10-year Treasury bond. Inverted yield curves, where short-term rates are higher than long-term rates, are pretty rare. They are also historically extremely good recession spotting tools. This chart shows the last 6 yield curve inversions. On average, you see it took a little over 18 months for the economy to fall into a recession after the yield curve inverts. Although it was an extremely short period of time, the yield curve did invert. We'll talk more about that and what it may mean for the economy here in just a second. This chart is from a guy by the name of Lance Roberts. I read him regularly. And as you know, you can never have too many Lances. So what the other Lance, I'm the cool one, what the other Lance is showing here is the lag between a Fed rate hiking cycle and a recession. So Jerome Powell, the chairman of the Fed, has kind of channeled his inner Paul Volcker here. He ordered one of those whip inflation now buttons from the late 70s, early 80s. He ordered one off of eBay and he's currently wearing it. Okay? Though there have been many examples of the Fed doing a lot of damage to the economy by raising interest rates, it is not always immediate, and I think the media forgets this as well. This shows on the left the start, end, and length of time in months that the Fed raised interest rates. Moving to the right, we see the Fed funds rate. This is simply the rate at which banks charge each other to borrow money overnight. On the far right, we see the inflation rate at the beginning of those interest rate hikes. Down at the bottom, we see that the average time from the beginning of interest rate hikes to a recession has been a little over 3 years, or 37 months. Now, the average time till a recession started after the first rate hike and with an inverted yield curve was a little less than 2 years, or 23 months. We still have to see how this rate hike cycle plays out. This is one of our big four and one of my favorites. The blue line shows the Conference Board's leading economic indicator index. It is a composite of 10 leading economic indicators, pretty diverse. The gray bars, which run up and down, represent recessions. What is pretty evident from this chart is that you see the leading economic indicator index peak and start to decline prior to a recession. The blue line will make what looks like a camel hump prior to the economy going into a recession. This is a very good early warning system for recessions. We watch this extremely closely and do not see a hump quite yet. It can often be very useful to see the correlation between certain data. What is interesting about where we are today is that the unemployment rate, currently at about 3.8%, is extremely low. Historically, unemployment rates are not going down when the economy is about to enter a recession. That's very rare. What is very interesting to me is the far right column showing the real or inflation-adjusted Fed funds rate. As of February 2022, the real Fed funds rate was negative 7.83%. Because of the volatility in both the stock and bond markets this year, people have gotten scared and have moved their money into the quote-unquote safe havens of short-term instruments like money market funds. We'll talk more about this phenomenon in just a second. The point I would like to make, though, is that people are sitting in cash earning next to nothing while inflation is currently over 8%. So I take my dollar and I bury it in my backyard. I feel very safe because I know that I won't be losing money in the market. Problem is, when I dig that dollar back up a year from now, it's not worth anywhere near $1, more like 92 or 93 cents. If I continue to do this, I'm going to go broke very safely. This is very similar to our last slide, only here we use the 10-year Treasury bond as our investment rather than a money market earning near zero. That should help a lot, right? Well, if you'll look at the far right column, which shows the real, or again, inflation-adjusted rate of return, you will see that you have lost money again the majority of the time. The bottom line is that somehow, some way, you have to give yourself a fighting chance at keeping up with inflation. This is a slide that we showed you last year, again from Lance Roberts, and it is still very useful today. This will show you what is called the Fed's balance sheet. In other words, this shows the dollar value of the assets, which are Treasury bonds and mortgage-backed securities, that the Fed has printed money and bought. Remember that the Fed's balance sheet is another one of our big four indicators. Since the financial crisis in 2008, and especially so during the COVID pandemic, the Fed has printed trillions and trillions of dollars and used that printed money to buy assets that it holds on its balance sheet. So currently the Fed has about $9 trillion worth of assets on its balance sheet. That's a lot. The Fed has come out this year and said that it would begin reducing its balance sheet by $95 billion a month. While this has caused alarm for the stock and bond markets, it would take about 9.5 years for the Fed balance sheet to go to zero at $95 billion a month reduction rate. Also on this chart is the stock market. You will notice that there is a tremendous amount of correlation between the two. Now, I do not have a balance sheet and real estate chart, but let me assure you that it would look very much like this chart with the stock market. Because the market has been so closely tied to the Fed's balance sheet, you see why this is such an important indicator to us. You know as well as we do that this has been a tough market environment this year. These two charts show some pretty good historical evidence of market rebounds after the stock market goes down. Here on the left, we see how much the stock market recovers a year later after it drops anywhere from 10 to 15%. Going back about 40 years on this chart, you see an average correction or drop of a little over 12%. What this chart also shows is that a year later, the market was higher about 92% of the time. That's a pretty high probability. On the right, we see what happens historically going back over about 40 years when the stock market drops 15 to 20%. On average, the market dropped during those corrections 18 to 19%. But 1 year later, the market historically was anywhere from 25 to 31% higher. This has happened about 91% of the time. Now, does this mean that the market is going to be up 25 or 30% by this time next year? Well, not necessarily at all, but there's a great deal of historical data, not emotion, to back that up. So this chart has similar data to the one we just looked at. Again, we go back a little over 40 years. Down at the bottom, we see the average market correction drop, in other words, of about 12.1%. We are obviously down a little bit more than that this year. We know that. But look to the right. That shows you that on average, the market has gone back up 1 year after the correction by anywhere from about 21.5 to 22%. This has happened over 92% of the time. At the bottom right, when we go out 2 years from the large market drop, you see that the market has gone up anywhere from 36.5 to 47%. This has happened a little over 84.5% of the time, going back over 40 plus years. Is this a guarantee? Absolutely not. No. But it is more historical data. As we've written before, we strongly advise using data, not emotion, to drive investment decisions. With the volatility in the markets this year, I've had lots of people call and tell me, Lance, it's different this time. These can be famous last words, whether I say it to you or you say it to me. What this table will show you at the bottom is the average market drop or correction after the Fed's first rate hike, going all the way back to World War II. That's a good, long historical set of data. We see that the average correction or drop is about 14%. The average length of time of the correction is about 4 months or 133 days. This year, 2022, we are down a little bit more than 14%, about 16%. We are also about 150 days into this correction. That's a little higher than normal on both, but we have seen this type of environment before. Let me say this. I don't profess to know everything, and I'm not going to be right all the time. However, I have been doing this for 25 years. You are not guinea pigs. This is not my first, second, or third rodeo. Believe me, we are very well aware that the stock and bond markets have been acting stupid this year. But please keep in mind that it's only June. We have some time to recover. Using the data, we can go back to 1942. With the exception of the train wreck that was 2008, the market has shown a propensity to go back up after starting the year down. We saw this as recently as 2020. We had a 37% correction during the COVID shutdowns and still finished the year up about 20%. Am I guaranteeing you that this will be the case now? Well, of course not, but I'm just showing you the data. So far, 2022 has been rough. Again, we are acutely well aware of this. But to quote the great philosopher Yogi Berra, this isn't rocket surgery. Going back all the way to 1928, which was right before the crash of 1929 and the beginning of the Depression, 2022 has had the fourth worst start of the year ever. But also note that out of the 15 worst starts to the year ever, the market actually finished up in all but 6 of those years. Warren Buffett is consistently one of the richest people in the world year in and year out. It is safe to say that he's done a pretty good job investing in the market. He also has a very famous saying that goes something like this: buy when everyone else is scared and sell when everyone else is greedy. He is basically saying what we have been telling you all year and in this report. Emotion is kryptonite for us as investors. This chart shows us what happens when investors get extremely frightened or bearish. Long story short, Warren has been right. When the average investor has panicked and sold at the bottom, the market went back up. What you see here is something called the Fear and Greed Index. It looked very much like a speedometer, except when I drive. And go back to what Warren Buffett said in the previous slide. When investors panic and this gauge shows extreme fear, the market usually turns around and goes up. On the flip side, when investors feel 10 feet tall and invincible, and when this gauge shows extreme greed, the market usually goes down. So I'm going to smack this poor dead horse one more time here. It is generally very prudent to use data to guide your investment decisions and do the exact opposite of what your emotions or your gut are telling you to do. We talked a bit earlier about something called the yield curve. Remember that when short-term treasury bonds actually yield more than long-term treasury bonds, we call that an inverted yield curve. The yield curve is one of our big four indicators. Disclosure disclaimer here. The yield curve did invert for a very short period of time earlier this year. It literally felt like I saw the yield curve invert. I got up, went to the kitchen to refill my coffee cup, came back, and the yield curve had gone back to normal. Very, very quick. Still, the yield curve is one of our big four indicators because it is an excellent warning system for recessions. Looking at the bottom of the slide, from the time the curve inverted to the peak in the stock market, the market historically went up about 32%. This process took an average of about 17 months. On average, you had a recession after 18 to 21 months. Now, the stock market this year is acting as if we are already in a recession. To be clear, recessions are typically very bad for so-called risk assets like stocks and real estate. We'll talk more about this in just a second, but we do not believe we are in or will see a recession this year. And we've always been told, don't fight the Fed. This is a very true statement, both on the way up and on the way down. But we also need to understand that there is a lag between the Fed giving the economy its quote-unquote medicine and that medicine actually taking effect. The data here is very similar to the other stuff we've looked at. From the time that the Fed began raising interest rates until the market made an all-time high was about 3.4 years on average. During that 3.4 year time frame, the market averaged a 67% gain. That's huge. Again, disclosure disclaimer. The Fed doesn't stop usually after just one interest rate hike. In this current hiking cycle, we believe that there could be 6 or 7 interest rate hikes. That many interest rate increases, I guess, could absolutely produce a different outcome for the economy and for the market. Now, higher interest rates do not necessarily always spell doom for the stock market. Now would be a very good time to talk about what interest rate the Fed directly controls and which ones they don't. Through its actions, the Fed directly controls very short-term interest rates like the overnight rate and the Fed funds rate that we discussed earlier. The market controls long-term interest rates. The Fed can absolutely influence longer-term interest rates based on what they say. In this chart, we use the benchmark interest rate, which is currently the 10-year Treasury bond. At the bottom, we can see that the average rate hiking cycle is about 26 months, a little over 2 years. On average, the yield interest rate on the 10-year Treasury goes up during these cycles by almost 3%. Somewhat surprisingly, the stock market goes up a little over 17% on average. So we've talked about the yield curve, we've talked about the leading economic indicator index, and we've talked about the Fed's balance sheet. That's 3 of our big 4. Our last contestant would be corporate earnings. Basically, common sense would dictate that if a company can grow its earnings or profits, its stock price can go up. For all of the market's misbehavior and all the hand-wringing in the media this year, corporate earnings for the first quarter were actually pretty good, pretty solid. In fact, 79% of the companies in the S&P 500 stock market index beat their earnings estimates. On average, these companies grew their earnings by 9% over the first quarter of 2021. You've heard us say many times that the quarterly earnings reports are like report card for stocks. And this is important. Earnings last year were absolutely spectacular. That is one of the reasons why the stock market was up so much in 2021. As an investor, think of yourself as the parent and the companies, the stocks that you own stock in, as your kids, all right? Last year, your kids were bringing home A pluses on their report cards every quarter. That's really good, right? Yes, but the challenge your kids or these companies have this year is showing improvement over the report card last year. As of right now, this is actually still happening. That's a good sign. Still talking about number 4, corporate earnings. This is a very interesting chart. We go back to the late 1940s and we look at corporate profit growth. The green line represents profit growth over this time frame. The gray bars going up and down again represent recessions. What you will notice is that there's never been a recession when corporate earnings were going up. As of right now, that's still the case. This next slide tells us a great deal. What normally happens when investors get scared is that they will sell their stocks and bonds and go to cash. Very normal. Looking down towards the bottom left, we see that there was 4.5 trillion with a T dollars in money market funds sitting on the sidelines as of May 11th this year. If the markets do happen to decline from here, you will see these numbers increase pretty dramatically. My takeaway from this is that there's a great deal of money, or maybe expressed as dry powder, that can be put to work through either investments or spending. Add this to the $2 trillion of cash sitting on corporate balance sheets, and we have right around $6.5 trillion in cash sitting there earning nothing. That's a lot of ammunition that can be used to help the economy and the market. I think it is also important to talk about the repercussions of this investment strategy. As we said earlier, with inflation at 40-year highs, this is a good recipe for investors to go broke very safely. With the barrage of marketing and all these gold and that all these gold and silver dealers do, it's not surprising that we get a lot of calls about gold and silver. One of the biggest challenges to investors this year is that there really hasn't been a place to hide. April historically is the best performing month of the year for the market. True to form, 2022 has had a mind of its own. The markets were awful in April, including gold. So far this year, there really hasn't been a free lunch. So we talked last year about the definition of inflation. I'm going to give you another term this year. It's called a Fed put. Fed put. So let's define this term that may or may not become extremely meaningful to us going forward. Okay? A Fed put, quote unquote Fed put, occurs when the Federal Reserve steps in to boost the financial markets when those markets drop below a certain level. This happened in 1987, 2009, 2010, 2016, 2018, and more recently the COVID bottom in March of 2020. Basically, the market drops so much that the Fed steps in and says, gee, we're sorry, we didn't mean it. They then begin to swing back in that pendulum we saw a second ago that we discussed earlier to reverse course and stop the bleeding in the financial markets. We believe that the Fed put currently exists somewhere between 3,250 and 3,000 points on the S&P. That would represent about another 17 to 20% drop from where we presently are. But do not discount the importance of the market in the overall economy. And there are people that get paid a lot more than I do to provide political commentary. So that said, I'm going to stay in my lane here and just stick to the historical data. In November, we will have our midterm elections because we are directly in the middle of Biden's term. Historically, the markets have grown less and have been more volatile during midterm election years. And that certainly appears to be the case this year. Continuing with that thought, midterm years historically will see the largest pullback or drop in the markets. You will notice that the markets have had periods going back to 1950 where they have dropped about 17% in that midterm year. And that's about where the market is today. That second year of the presidential term has historically been the most volatile. Here we are. But also see that the market rallies historically quite a bit 1 year after that drop. And toward the end of these halftime reports every year, we always talk about what could go right and what could go wrong. One of the things that we always use on that list of things that could go wrong is something called a black swan event. A black swan event is something that really doesn't have anything to do directly with the market. The COVID pandemic of 2020 was the poster child for black swan events. This year's black swan event has been brought to us courtesy of Vladimir Putin with his invasion of the Ukraine. Please note that this is most likely a case of history repeating itself. So contrary to what the media is telling us, this is not the first time in history that one country has invaded another. This is not the first time in history that some nut job with a large army has attacked another country on its border in Europe. Here we see a long list of geopolitical events, generally wars that have taken place. Again, we're not reinventing the wheel here. Down at the bottom, we can see that the average drop in the market during all of these events, going back, I believe, to Pearl Harbor, is about 4.6%. On average, it took about 20 days from the headline event for the market to bottom. And it took an average of 43 days for the market to recover. Please be careful saying that it's different this time. That said, the Ukrainian invasion has certainly stoked the fires of inflation, particularly in the oil and grain markets. Russia is a fairly large exporter of oil and gas, particularly to Europe. This area of the world has historically been known as the breadbasket of Europe. Lots of wars fought in this area over the food supply. About 1/3 of the world's wheat is produced on the land that they're fighting over right now. This has put a pretty good strain near term on an already broken global supply chain. As to the long-term repercussions, please keep in mind that Russia and Ukraine are only about 1.5% of the world's GDP combined. So in closing, here's what we think. We believe we reached peak inflation at about 8.5% in May. We believe that the data will show inflation dropping to around 5%-ish by the end of the year. That will hopefully give the Fed a reason to back off of the chemo and the radiation. We do not believe we will see a recession this year. Our base case is that we will probably see a recession in the second half of 2023. We see GDP, the bottom line report card on the U.S. economy, dropping from about 5.5% in 2021 down to about 2.5% for this year. Not spectacular, but still positive. We believe we'll probably see 5 interest rate hikes this year and more QT, more balance sheet reduction in 2022. Our year-end price target would be between 4,250 and 4,500 on the S&P. While that's down slightly for the year, that represents about an 8 to 12% increase from where we currently are. Let's talk about what could go right with our forecast. Well, the economy could recover some after a bad first quarter and finish the year positive. We could see some badly needed improvement in the global supply chain, particularly if China reopens. the market could rally from some very deeply oversold levels. Corporate earnings could continue to be pretty strong overall. We could see some de-escalation and maybe even a ceasefire in the Ukraine. And lastly, maybe the Fed doesn't mess it up this time, at least not yet. What could go wrong? Well, the economy could continue to weaken due to inflation and the Fed's efforts to control it. You could have another black swan event. I hope not. We're past due for that. Hope not. We can have another major surprise or uncertainty in the midterm elections, something the market doesn't expect. Putin continues to head west through Europe in his land grab. Rising costs, a struggling consumer, and a dysfunctional supply chain continue to hamper corporate earnings. Or the Fed could mess this up, swinging the inflation pendulum back over to the dark side. We saw recently with both Target and Walmart that their earnings were not very good, and that's kind of point number 5 here. Rising costs, a struggling consumer, and dysfunctional supply chain really affected their earnings. I want to say thank you again for tuning in. We appreciate your time. And as always, please don't hesitate to reach out if we can help you or should you have any questions. Once again, Lance Browning, Income Solutions in Tyler. This concludes the 2022 Halftime Report. God bless and have a great rest of the year. Bye-bye.